Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. Great to have you here today. We got a full hour of information to make you a smarter investor. We're going to start off with another lawsuit against generative AI company Perplexity for copyright infringement. This is so important. There's so many things going on here behind the scenes that could blow up. We'll talk about that. And we've talked about Apple in the past. We thought we were pretty much done talking with it. But just when Apple corrected their major problems that they had, well, now it looks like there's a management drain. And actually, I'll call it a brain drain. It's actually leaving them. And then it's time to put some commercial property into your portfolio. You may be questioning, saying, why? We'll explain why. We think now is the time for commercial property. And Chase, what do you got?
Yeah, so companies we're going to look at today includes Brinks. They're the armored car and cash handling provider. And I saw this and I'm like, we've never looked at this company. I'm so curious. I see their trucks and I'm like,
who are
there's
they?
anything here. They had some news as well. We'll get into that when we look at the numbers. We're also going to look at PVH, Pure Storage, and then a little company called Kroger, the grocery store company. So as always, we'll break down the fundamentals, give you an opinion if we think it's buy, sell, or hold, based off the numbers we see.
And people that don't know PVH, who is that?
That's going to be Tommy Hilfiger and then also Calvin Klein are their two major brands.
Yeah, so that's that, like, oh, okay, I know who they are. So, well, let's talk about, is it time to put some commercial property into your portfolio? You may be questioning why. Would I put real estate like commercial property into my portfolio that over the last 5 years or so, the return has been maybe 7% versus stocks that have done far better? Well, the simple answer is the basic investing principle of buying low and selling high. Simple as that. Looking forward, I believe commercial real estate over the next 5 years should get better returns than the artificial intelligence, the tech stocks, all these that are so expensive. They're just so pricey, they can't keep climbing. You want to buy things on sale.
Yeah, a lot of times people, they say they want to buy low and sell high, but ultimately what they end up doing is they buy high in hopes of selling higher, which to me, I don't really like that philosophy.
That's a greater fool theory.
Yeah, that is a greater fool
finance
theory as well. Yeah. But kind of looking at the data here from MSCI, that revealed year-to-date, large investors have purchased $4.6 billion more U.S. commercial property than they sold. That is the first time that has happened in 3 years, and deal activity is still low compared to history. U.S. commercial real estate values, well, they're off from the peak in 2022 and are now down around 17% on average. So, I mean, we have seen, again, a pullback, and we like when things go on sale. This has gone on sale.
And, you know, Chase, when we were first doing that research on this, and I saw that initial number, $4.6 billion, like, wow, that's a good number. And I saw like, oh, well, it's not like that. It's a good number, but it could be much higher. And I didn't find it, but I think the overall commercial real estate market is probably huge, very huge.
Oh, it's got to be trillions.
Trillions, yeah. So 4.6 billion, look at it that way. Yes, a lot of money, but could be a lot more.
And what this could signal is an inflection point, right? Yeah. So you've been seeing net selling. All of a sudden, this could be the flip of net buying, and then that's where, you know, buying starts to cascade. Instead of 4.6 billion, it goes to 10 billion, 15, 20, 30, 50 billion, you know, and that number starts to climb over the years as we have potentially now seen that inflection point where values turn around.
Yeah. And looking just at the commercial offices, there is a better discount considering they are down around 36% from their peak. Now, history shows this could be a very, very good opportunity. There's only been 2 times over the last 50 years, roughly 50 years or so, when commercial property prices were down more than 10%. You'd have to go back to the early 1990s, and that was about 35 years ago. And then who could forget the other one, 2008, the Great Recession, commercial property, residential property, a lot got hit hard that time. But that's only one of the 2 times over the last 50 years that we've seen this type of action being down more than 10%.
Yeah, and we actually do have a office REIT in our portfolio. I'll kind of talk about that in a little bit more detail as we progress here. But in the office space in particular, when we're listening to the CEO and the COO or the chief operating officer talk about what's going on, they say leasing trends are very good in the office space. as long as you have the right properties.
Right.
And I mean, this is the thing when you look at real estate, again, people kind of peg us many times as just stock guys. But when you find good real estate, it's the same thing. You know, if you can find good real estate that is undervalued, good cash flows from the rents, that's what you want to be buying. And I think you can find that in the office space. You just got to be careful. But what I was going to say is, the nice thing with real estate is many times it's all based off supply and demand. So what happens is as that office space has really fallen out of favor, well, construction has slowed down quite a bit. You've seen some conversions from office space into retail space or into housing. So what that then means is now there's a lower supply of office out there, which then kind of really helps fix that supply and demand equation. And that's where, again, you can find some good opportunities.
And Chase, this is where you have to know what you're looking at because, again, not all real estate, commercial real estate is equal. And also, too, you have to understand how it works. We talk about rate abatements. There's so many things that you have to understand. The cash flow. Well, gee, the rents are down. You have to understand that. Maybe they signed a new lease for 7 years, and they're giving the new tenant a 7-month free rent to get in there. Well, they're not going to collect rents for 7 months, but then it will pop up later. You've got to, even when it comes to stocks, businesses, you've got to understand things. You can't just do a 5-minute analysis and say, oh, this is going to be great. No, you got to do your homework.
Yeah, and you know, maybe now you're listening saying, well, how do I invest in the real estate?
That's the important part.
The best and easiest way, and the way that we actually do it at our firm, is to use public real estate investment trusts, which are known as REITs. I talked about that office REIT that we have in the portfolio. It is public. Please do not let your broker sell you private real estate of any sort so that they can then get paid a big commission. REITs that trade on the market are commission-free and completely liquid, unlike those private real estate deals. And with public REITs, you can many times receive good investment yields between 4-6%. I know we have some great REITs in our portfolio that are paying around that range. And the thing that you have to understand, you have to put up with volatility with the public REITs. But again, you can get in and get out of them. There's no difference. You do own the real estate with the public REITs. It's not like, oh, it's some gambling chip. No, you own pieces of the properties that are owned by this real estate investment trust. It's a great way to get exposure.
Yeah, and I would say it seems to be quite frequently we talk about do not get into the private REITs. Do not be sold the alternative REITs and all these things that brokers sell you. We still continue to see new clients come in. Yeah, I got this stupid REIT. I can't get out of it, you know, and people don't realize. And the brokers, there's some great salespeople out there. Oh, this is different. Whatever they say, we got to keep hammering that home because the only person that benefits from the private REITs generally is the broker who gets probably a 4 to 6% commission depending on what type they sold you.
Yeah, and it's just difficult because if the real estate market turns, and you know, I don't like to obviously sell things, but if you need to sell, you can. Where with the private real estate, things turn unexpectedly. You're locked in. You can't get out. And you think the REIT is going to want to give you your money back when things are going poorly? No.
And also how they value that's another thing too. However, make sure to understand the fundamentals to ensure that that dividend yield is safe. A history lesson shows that commercial property underperformed from 1997 to 2000 when the tech boom was happening. But when the tech boom ended and went bust, guess what? Commercial real estate did very well. Could the same thing happen now as there are signs that the AI rally could end? Well, if you do invest in a good quality public real estate investment trust, you should have at least a 4 to 5 year time horizon to hold that investment. Don't think you're going to get into it and you're going to buy the REIT at $10 a share and gee, next month it's up to 11. That's just not going to happen. You know, it's just amazing how people forget about the long-term investment. That's how you do well, by the compounding, buying good quality, not hitting the next home run that goes up, 30, 40, 50%. I think Oracle was way up, and I think it went way back down again.
Yeah, I mean, it's fallen, I think, like 40% or something from its highs. And, it's had an all right year, I think, still positive. Yeah. But at one point, it was up like 80% or something crazy.
And you have to realize with investing, the reason why it went up is because people were buying it on the way up. Oh. So there's probably a lot of people that have overpaid for it, and they're now underwater because they got sucked into that hype we talk about.
Yeah, just because people have made money on Oracle this year doesn't mean everybody's made money on Oracle this year.
Good way to put it. Yeah. All right, let's talk about, you want to talk about Apple here?
Yeah, let's switch gears there.
Okay. Just when Apple corrected their major problems, it looks like, there was a management drain. I'm going to call it a brain drain because it's not just management. Apple, again, we talked about it. That we were concerned with them. They had a lot of problems. They did a great job handling the proposed tariffs on its products. which would have, keep in mind, that would have devastated the company. Also, in court, they managed I forget the gentleman's name now, that testified in court, did a great
I
job.
it's like Eddie Q or something.
Yes, you're right. Eddie Q it was, yeah. And they got to keep the $20 billion a year they received from Google. But now they seem to be fighting a management exit by some of their top executives. Now, just over the last few weeks here, it was announced that both their general counsel, and that's very important, he's the guy that runs the whole legal department, and head of policy, also running the legal department, they're going to be retiring next year.
And another major concern was also announced in that time frame that their head of artificial intelligence and strategy is also going to retire. Making matters worse, their chief operating officer said he'll be retiring in July of next year. But it looks like right now you don't have to worry about CEO Tim Cook being age 65. He said he is not considering retirement, and people at the company said he is not slowing down at all. I did want to go back to the head of artificial intelligence and strategy. I mean, some people think maybe this is a positive because their AI strategy has been pretty lacking, to say the least.
Yeah, that could be true, but still, he obviously got there for a reason. Well, that probably wouldn't be under the legal department side. That's probably under the research side.
Yeah.
So, but it's not good that he's going to retire. But it was also announced that Meta has taken from Apple a top designer. His name was Alan Dye. Also, Johnny Ive.
Johnny Ive.
Johnny Ive. Is that?
That's how you say it.
Yeah, Johnny.
Johnny Ive. Yep.
I guess Johnny would have an A in there, wouldn't it? Yeah. So Johnny Ive, who was Steve Jobs' protege and helped build the iPhone along with the Apple Watch. These are two major things that's going on. Well, he's heading over to OpenAI to help out who? Sam Altman. It's not just the top people leaving, though, as apparently dozens and dozens of Apple's engineers, along with designers, and these are very important people who are knowledgeable in audio, watch design, robotics, and much more, are also finding a new home where? OpenAI.
And I think that one, if I was an Apple shareholder, would be the most concerning. Reason being is, people keep talking about, obviously the iPhone was transformational. At some point, there's going to be something new that is transformative like the iPhone. I don't know if it's going to be in 2 years, 5 years, 10 years, but at some point there will be something transformational that could really hinder smartphone sales. That Johnny Ive guy seems to have a pretty good track record, and it seems like, again, he's pulled some of the top talent away from Apple. That could be a big concern.
Oh, yeah, and there could be more to come as well.
Yeah. But, you look at running a major technology company like Apple and striving for new innovation, it makes it difficult when a company is losing top management and star engineers and designers. And I don't think this will cause a major drop in the stock in the short term, but it could be difficult long term for the company when it comes to innovation and new products, as I mentioned, which could concern investors in the years to come. And, that's kind of, again, the big concern I have is I don't even know what it could be. Could it be something just in the palm of your hand where you click and there you go, there's your whole world? I don't know. But there will be something that will change how we use smartphones at some point down the road.
Oh, yeah. It's not going to stay the same. And I remember before, we worry a lot because we're very conservative. And the worries we had, they were corrected. But this one, I don't know how you correct this because, again, there's a brain drain. And Apple's doing fine now. Everybody's focused on the iPhone sales for the Christmas holiday season here. So, oh, yeah, it's doing great. But what are they going to do for an encore? And again, when you start looking longer term, as you pointed out, you've got to have new innovation coming in. If you're losing your top people going out to OpenAI, they could be the lagger. And they traded high multiple still.
Oh, they traded a very high multiple still. I think in the high 20s, low 30s potentially in terms of their forward multiple. And, we actually did another post on the newsletter here this past week about Meta. Meta as well, they are really striving for product.
Right.
And, whether it's an AI glass that they're using, and I say the Ray-Ban glasses, that could potentially steal market share away how we use the smartphone. Mm-hmm. And I personally right now can't foresee myself doing that, but who knows? Something will come along that changes our view of the smartphone. And the big thing Meta's talked about is, kind of maybe having their own type of app store.
Yeah.
Right? Apple right now, they've created this, they call it kind of the walled garden, so to speak, where they control everything that goes on in that app store. And Meta's like, we don't want to have to deal with that anymore. We want our own app store, right?
Yeah.
And that could be a huge problem. Whoever can create this next product, whether it's OpenAI or Meta, and then you create your own app store, I mean, now you're just siphoning money off of Apple. And, the top dog doesn't stay the top dog forever. And Apple's been top dog for quite a while.
Quite a while. And also, too, who wins here is the consumer. And that's why you have to be careful, because competition's great with the consumer. It is great these big companies are competing, coming out with new products. But again, it can really hurt the companies, because if they're trading at high multiples and they lose all these people, then the stock falls. Again, consumer wins, but be careful about where you invest your money, because there could be problems. And again, people say, oh, well, you were on Apple before. No one knew how that lawsuit was going to come out, or that they were going to fix a tariff situation. So.
Yeah, I wouldn't say we were wrong. It's just, again, we were skeptical. And I'm still skeptical of a company that trades at 30 times earnings, because we always go back to this. And this could be, as I said, you don't know the future. And I'm not willing to overpay for a company because, as I said, 5 to 10 years from now, who knows what could be the new smartphone? And you go back to when the smartphone was created, what has that done to the Nokias of the world? Remember, again, the BlackBerry? That was cool and innovative. Or the Razor flip phone. Wow, that thing was sweet back in the day. But those are no longer mainstream. They're no longer cool. And at some point, it could be very possible that the iPhone is no longer cool.
Did you see, and I've considered Samsung, they've come out with a trifold phone that unfolds, and it's about the size of a cell phone, so you're going to have it that way. But if you want to, you can unfold it 3 times, not twice, but 3 times, and you almost have a tablet in your pocket.
Oh, it is so funny when Apple, I mean, just the fact that they've sold people on this brand so well, and you have to give them credit. But they are far behind the other players in terms of the technology. I mean, Samsung's had the foldable phone now for, I don't know, a couple of years. And I saw Google Pixel, they now have a foldable phone. And it's like Apple, they're talking about next year being a big thing. And it's like, it's been a while.
I mean, I probably need a new phone. Maybe next year I might consider that Samsung triphone, because that sounds pretty cool. So we'll see what happens in 2026. But
it's too techie for me. Sometimes I consider going back to the dumb phone and maybe getting a Razor. I don't know.
But just think about it. To unfold that phone, you got to, because that's, as you get older, it's harder to see things. So, wow, great. Now I can see this whole big thing, not this little phone. So, let's talk about another lawsuit against generative AI company Perplexity for copyright infringement. The New York Times has had enough, they said, and they filed a lawsuit in New York federal court in October 2024. The Times sent a notice to stop accessing and using their content, and then they followed up with another notice this past July. Now, Perplexity continues to ignore the warnings, and a spokesman for the company, I don't know, this guy amazed me what he said, but Jesse Dreyer said publishers have been suing new tech companies for hundreds of years, starting with radio, TV, the internet, and social media, but that has never worked out for them. This guy was so flippant about it, like, really? I mean, you're infringing on copyright laws, and he was just no big deal. I'm shocked.
It is interesting because those are all just platforms, right? Like radio, TV, but you still had to create your own content. You're not stealing other people's content.
Good point. Yeah.
It's a interesting kind of example to use because I do feel like they're very different. The only one I could kind of see is social media because people are then taking it and then sharing out different content. But you still have your name on it, right? So like if you share a New York Times article on Facebook, New York Times is still there.
And if you're not making money from it, it's the other thing too. So that's a problem they're starting to run into.
Yeah, and as you said, I do think it's a little bit different since AI pretty much takes the content directly from the publisher and then publishes for people to read. And like you go on ChatGPT, you just get an answer. You don't get like any real like, oh, this is from the New York Times. It's just like, this is the answer. And when you look at what the Times is saying, they're also going to include infringements for use of its video, podcasts, and images. The Times in the lawsuit, they are seeking damages, which at this point is unknown, and injunctive relief, which includes removing all of the Times content from Perplexity's products.
And I just don't know how you get in front of a judge and judge says, sure, it's okay to infringe on their copyrights. That's fine. Steal their product. I think this will be in courts for a while. But I think it will be a problem to where either Perplexity or these other AI companies have to pay for the content that they're using, not just take it for free.
Yeah, and I mean, I'd have to imagine it'd be a hefty cost because, I mean, if this does go mainstream, then you're really talking about losing all of your revenue. So you'd have to make all your revenue from selling the licensing to these AI companies. I mean, it's quite the dilemma. I'll put it that
is.
way.
And then on the other side, we've talked about that a lot of people won't pay very much, if anything, for the AI content. We want it for free, so that could be another problem. But this is going to be a major problem for Perplexity. If they were to lose this case because of the whole AI system pulls information from all across the web, and this would leave a big hole in the end result of Perplexity's information. If they can't use it, they got no content. They got nothing to sell. The Times is not the only publisher suing Perplexity. You also have lawsuits from Dow Jones and the New York Post as well. So they're really coming from different angles. I think there could be other ones as well, but I didn't see those listed.
Well, and my big concern is if one company were to win in court, well, that would then be a major problem for the AI companies. First, it would set a precedent. And other publishers were then likely. So you said maybe there aren't lawsuits yet, but let's say they win. Well, why wouldn't I sue them? I already found out that you can win and you get money and they can no longer use your content unless they pay you for it potentially. So I think it would bring on more lawsuits. And it could also lead to less accurate information as there would be less sources to pull data from. As you said, I mean, there's got to have to be some solution here, right?
Right.
Because AI in and of itself is still not creating data. It's pulling and summarizing data. So it has to get it from somewhere. If all of a sudden you cut the number of resources that you can pull it from, well, that's bad. Or you have to pay a ton more for that. And here's the thing, right? We've talked about this before. And this is where the AI trade is just so, I think, scary. Is you have Anthropic, you have OpenAI, you have Google, you have Perplexity, you have all of these different players there. You're not going to have all of these chatbots. You just won't. You're going to have what happened with Google. Remember Ask Jeeves, Yahoo, those types of things. Who won? Oh, Bing was the other one. Bing is like, what, in second place with like 5% of market share or something crazy like that.
Yeah.
One of them will be the dominant player, and the other ones will just basically probably lose all of its value.
Yep, exactly. And then what if there's a class action suit? Everybody gets on board together and goes against them. That could happen. So, all right. All this information does come from our website, the Smart Investing newsletter. It is free. Goes out every Friday at 5 o'clock. Other topics there and it's always hard to choose the three for the show here. But should Meta Platforms change its name again? Competition is coming for NVIDIA chips. The risk in AI bonds is increasing as the AI build out continues. Should you do a year-end review for your investment portfolio? More concerns, again, about private credit and why investing in hype names or stocks with no fundamentals is very dangerous. That's all free information on our website, very educational. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. All right, let's look at a company. I guess I'm going to start off with Brinks today, right? Brinks, the big security and protection services company. Their symbol is BCO, and you see this all over. You see the trucks just driving around, and they have a lot of other services as well, which I know you'll kind of give those also. But let's take a look at Brinks. Again, symbol BCO. Short on the float side is only 2.7, so not much there. We do see that the PE ratio is a little bit high, 30.4. Actually, it is high, 30.4 versus 23, but price of sales does look good, 1 versus 1.6. Price to book value very high, 18.5 versus 3. We do see price to cash flow, 8.1 versus 12.3, and the PEG ratio very good, 0.6 versus 31.4. Now, Brinks has done a great job growing their earnings over the last year. They're up 48.3% versus 6.9%. Again, we talk about understanding that number because they could have very low numbers the previous year, and then this year was back to normal. So understand these numbers by looking at the income statement, the profit and loss statement to make sure where those numbers are coming from. We do see sales are up 3.1% versus 4.9%. The 5-year earnings per share growth estimate from the analyst, very good, 23.4 versus 5.7. Now, they do pay a dividend, not very much, about 0.9%, using 25% of their earnings to pay that out. Taking a quick look at the balance sheet, current ratio 1.5 versus 2.5, but I'm okay with that. Strange thing here, debt to equity 16.1 versus 1.3. I'm trying to think why. It's not a franchise company. I'm not sure why that debt is so high. I'll try to look at the balance sheet when you kind of look at things as well, Chase. They do have a net profit margin of only 3.3% versus 7.2%. Return on equity is 63.4 versus 14.2, so that tells me perhaps they have very low equity and maybe normal debt. Maybe that's the situation, but we'll check that for you. And then we do see free cash flows only $418 million versus about $1 billion for the industry. So some concerns. What do you got going forward?
Well, they do provide cash and valuables management. We know about the trucks. We know about the guards, the security. But the other thing is they have ATM managed services. So this looks like cash replenishment. So I don't know if they hold cash and then maybe that they like replace it. There could be something that has to do with the balance sheet, like treasury management, cash forecasting, cash optimization. If they're like kind of borrowing and then lending money short term or something, it could skew the balance sheet. So just kind of looking through that was interesting. Obviously, they do transport other valuables such as diamonds, jewelry, precious metals, things of those.
Did you say you looked at the balance sheet?
No, I didn't look at the balance sheet, but I'm just saying that whatever you look at the balance sheet, it could be skewed because of their services that they offer. The other thing, too, I was going to say, when I look at this business, I do wonder if cash becomes less common, will this have an impact on the business?
I was thinking the same thing.
Yeah. So, but let's look at the numbers first to kind of see if there is any value here with the Brinks company. Their ticker symbol again is BCO. Current price is $119.45. 52-week range. I mean, gosh, it's done good. The 52-week low is $80.10 and the high $122.50 so far year to date. The stock is up over 28%. Going forward for the business, we go out to December 2026. I see estimated earnings per share here of $9.17, gives us a target sell price of $152.22. So, I mean, it trades at a forward PE of around 13 times. And pretty soon we would be shifting out to 2027 as well, looking for decent growth that year as well. So, I mean, the valuations actually don't look too shabby for this business.
And actually, I did look at the balance sheet. The assets they have about $6.9 billion. Their liabilities are pretty high at $6.5 billion. So it gives you equity of only $269 million. And they do have a high amount of debt. It's about $4 billion. So they're carrying a lot of debt in the balance sheet. But, there could be reasons for it. And this is where we can kind of give you some numbers where we say this is not the end of the research. It's the beginning. Because there could be, what's the target sell price? How much do we have?
Is it like 152.
And where's the stock at now?
119.
So we got 30% potential gain there.
It's about 28%.
28%. Yeah. I don't know. I mean, worth maybe watching.
Well, as I said, we're going to flip to 2027 earnings here pretty soon as well.
Yeah. And you brought up the cash, though. That's something that could be a concern.
Yeah.
All right. We're going to take a quick break here. When we come back, we're going to look at 3 more companies. Going to look at PVH, Pure Storage, and Kroger. Also, to our financial planner, Harrison Johnson, the benefits of capital gain harvesting. Stay with us. We'll be right back. All righty, welcome back to Smart Investing Show. And with us, we do have our financial planner, Harrison Johnson, CFP. Harrison, thanks for being here today.
Always.
We got a topic here, and I said, well, didn't we just do this last week? But it's a kind of the other side of it called the benefits of capital gains harvesting. Explain what you're talking about here.
Yeah, so last week was capital loss harvesting, taking a position that's at a loss, using that loss to then offset other gains that you have. Sometimes it makes sense, sometimes it doesn't, depending on the situation, the tax savings, market value, and everything. But this time it's, capital gain harvesting. Not talked about as much, but capital gains are taxed differently than other types of income. You have your 0, 15, 20% capital gain tax brackets, but in some cases, you're able to realize gains intentionally, so realize that income because you might be able to do that in a lower tax bracket. So, for example, a married couple, standard deduction is a lot higher now this year, and itemized deductions, I think, are going to be more prevalent with the repeal of the SALT cap. So a married couple can have an income over $150,000 while still being in that 0% capital gain bracket. So that means they can sell something, realize that gain, pay no taxes on it. And with capital gain realization, wash sale rules don't apply. That only applies to losses and then buying it back. So what that means is you can, sell something, realize that gain, and then buy it back immediately. And what that does is it resets your cost basis, essentially tax-free potentially, if you still want to hold that investment. So it can be a benefit, especially if you're looking at the end of the year. If you've got some room in a given tax bracket, might be worth it to realize some things, take advantage of the low tax environment that you're in.
And this is so important for people to understand because there can be benefits to it, but you have to know what you can do, what you're doing. You can't just do it, off the cuff here. You've got to say, okay, what am I selling here? How much is the portfolio? How much gain could I have on that? I mean, you've got to weigh all these factors. It's not like, oh, I got a gain, I guess I'll do a tax loss harvest on that.
Yeah, exactly. It depends on the situation. And one of the reasons why I was talking about this is I was speaking with a client yesterday, and they are expecting a lot of income next year.
Yep.
They happen to be this year in a 15% capital gain tax bracket. Next year, they're going to be in the 20% tax bracket by a long shot. So they're in their portfolio. There were some investments that we were holding off selling until next year because we already had some gains this year, but because they're going to have so much income next year in the 20% bracket, it's worth accelerating those gains that we were going to realize anyway because we can do it this year while in the 15% tax bracket. So it's not all just about trying to do it in the 0%. Sometimes if you can take advantage of a 15% bracket, because maybe you'll never be able to get into the 0% bracket, 15 is still lower than 20, so there's a benefit there as well.
Yeah, and I just kind of look at it. It's a great thing. Let's say you have like $500,000 of unrealized gains in a trust account, and one thing we talked about too was, does it make sense to do capital gains harvesting or do a Roth conversion if you're in a low tax bracket? So there are different considerations, but let's just for simplicity's sake say you have a $500,000 gain in a trust account, no Roth, no retirement account, just very simplistic. There's no reason in my mind why you wouldn't do capital gains harvesting if you're in that lower bracket to reduce that potential tax bomb that could hit you down the road.
Right. You don't want to have, the missed opportunity of that, and then you finally have a huge gain, and now that not only pushes you up into a 15% bracket that could have been avoided, but it also then triggers IRMA because it's included in your income. So kind of spacing things out with a given allowance, so to speak, that you have can be very helpful.
Yeah, and I think it's very important for the investor to know, though, that you can't just sell just because there is a gain. I mean, the reason why we did it, we looked at saying, gee, these companies are very close to the target sell price. There's a big concentration on one of them in the portfolio. You've got to have reasons. You can't.
I disagree with you there.
Why would you disagree?
Because the difference, again, that Harrison mentioned is with tax loss selling, you have to wait 31 days. With tax gain selling,
right,
you could literally sell
buy back
and then buy, not even the next day, the next second.
Oh.
There's no rules against selling and buying when you're taking gains.
But what could happen to you within a year, say that hit its target sell price, now you got a problem where, shoot, now I got a short-term gain because I did that. So it's just, there's so many, it's not an easy answer. It's not like, just do it because you got gains. There's so many things to consider. And this is where I think many times a small investor, I can do it myself. This is easy. They miss all these things that we look at to make it better for the longer term. So many things.
And this kind of goes between, financial planning and tax planning on one side, and then investment planning and investment decisions on the other. They're two sides of a similar coin. You want to weigh both of those so you can make the right overall decision for a given situation, because you generally don't want to, make a tax decision that really hurts your investment decisions or your investment outlook. But if there's opportunities from a tax perspective that, you can mitigate tax liability while also using that to complement the investment side of your portfolio, that's ideally the goal.
That's why I think at Wilsey Asset Management, we have the best for people, because we have Chase and I doing the investment part, you doing the financial planning. I mean, these are two full-time jobs. Nobody can do both of these accurate, trying to do financial planning and do investing.
So I think we do a good job too.
Oh, I think we do a great job. We got a Christmas card from a client today and said, you guys have saved my life. You've done a great job, or you're the happiest clients. Because we spend so much time, and they go, we know how hard you guys work, because we spend a lot of time looking at the situation to make sure we're doing the best thing, not just on the investment side, not just on the financial planning, not just on the tax side, but all together for clients. So a little bit of plug for Wilsey Asset Management, I guess. All right. Well, Harrison, thank you very much. Great information. Appreciate you sharing that with us. And if you want a free consultation with Harrison, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or send him an email. Go to the website, smartinvesting2000.com. Again, smartinvesting2000.com. Send an email saying, hey, I'd like to have a free consultation with you and talk about my portfolio. So, all right. Let's see. Time to do another company. Are you ready?
Yep.
Okay. Let's talk about PVH. And you said that was Calvin Klein and who?
Tommy Hilfiger.
Tommy Hilfiger, that's who it was, yeah. They are in the apparel manufacturing industry. The shares on the float getting a little bit high at 8.7, so I'm wondering why that is. People thinking that the stock is going to drop. We do have a good PE ratio of 11.5 versus 22.4. Again, the name is PVH, but the symbol is the same, PVH as well. I want to make sure you catch that there. Price of sales, very good, 0.4 versus 1.3. Price to book value, 0.7 versus 3.3. We do see price of cash flow also good, 6.6 versus 12.7. PEG ratio, another good thing, 1 versus 8.1. So the valuations on this company look very, very good. We do see, unfortunately, and maybe Chase will answer this, but the earnings per share for the last year were down 46.4% when the industry was up 21.5%. We do see sales did climb by 0.5%, not nearly as good as the industry, up 5.7%. However, analysts going ahead for 5 years on the earnings say they see earnings growing per year at 7.2%, and that's above the industry at 5%. Now, they do pay a dividend. I'm not sure why. It's 0.2%. They use 2.3% of their earnings paid out. Why even bother? I mean, I don't get why companies do that. It's not worth it. It's pennies on the dollar. We do see on the balance sheet, current ratio 1.5 versus 1.9. Debt to equity 0.9 versus 1.1. Net profit margin 3.9 versus 5.9. That's kind of okay. Return on equity 7 versus 23.7. That's not very good. Free cash flow $442 million a year versus $725 million a year for the industry. I mean, I'm seeing things, except for the valuation ratios, I'm saying, it's okay. I guess we're going to see what we got going forward on the growth there.
There's a current price for PVH Corp. Their ticker symbol, very easy. PVH, well, it's $75.27 here. 52-week range, the low, $59.28, and the high, $111.71. Over the last year, the stock is down almost 30%. Over the last 5 years, it's down about 18%. And your 10-year return, nothing to write home about, a 6% gain over a 10-year period.
Wow. And actually, well, that's kind of strange because I have the dividends. I show a 10-year return of a negative 1.3%.
That is interesting.
1.3% decline or 6% gain. Neither one's very good over 10 years, so let's not argue about that. I guess. It's bad.
Well, going forward for the company, I mean, this is where things are intriguing. You go out to January 2027, I see estimated earnings per share here, $11.98. I mean, it gives you a target sell price of $198.87. So the valuations are attractive on the business. We did look at this earlier this year, and I kind of want to take a look at it again. We looked at it earlier in the year after they were added to the unreliable entities list in China. That really caused the stock to take a huge hit.
Oh, because they get a lot of products from China.
Well, it looks like I was trying to find some numbers here. I mean, China only accounted for about 6% of their sales, but it accounted for about 16% of profits. And this looks like in fiscal 2023. I didn't have time to obviously dive into it. This is just based off what Google showing me. And production is about 18% in China in fiscal 2023. So, again, China is a part of their business. But with the improving China relationship between here and the United States, that, hey, maybe things would have recovered, but it seems like they are having other issues as well. Looks like I had some disappointing guidance this past week as that caused the stock to tumble 10% again. So, I mean, the company has some issues going even outside of China, maybe with that brand or their brands, I should say, with Calvin Klein and Tommy Hilfiger. But here's the interesting thing I always look at with apparel is we've had success in the past with, I'm going to say, two different retail companies, two different brands. They were purse companies, not kind of these types of businesses, but same concept. Two different ones over the last 8 years. Retail can be very hard because it goes in and out of favor. So those stocks can be volatile.
Yeah.
But if you can pick it up on a downturn, you can make good money in this space as long as that brand comes back in a favor. But I even look at like a American Eagle and Abercrombie and Fitch. I mean, they were out of favor for a while, and now they're hot again. I mean, that's the hard part with retail. It's very fickle. You don't want to buy when I think everything's going great because that trend can turn, and then all of a sudden the stock does. But when things are out of favor, I mean, I'm not going to say I'm going to run out and buy PVH tomorrow, but, I think there is some level of intrigue there.
And he got some, good names there. Tommy Hilfiger and Calvin Klein, I think you said it was. I looked at the balance sheet again. The debt to equity is only 0.9. So this is one thing I want to be careful. They don't have a lot of debt through these down periods that could hurt them. And also, too, there seems to be a China issue there as well in the manufacturing. That will eventually somehow play out and be gone. Either the manufacturer somewhere else or the thing with China will come to the table and we'll deal with that. So there could be some potential I'm hearing as well for this company. I don't think I have anything from Calvin Klein or Tommy Hilfiger.
I just don't like clothes.
Well, you wear them.
I do wear. Yeah. I'm not a nudist or anything, I just
You don't like brand name clothes.
yeah.
You just,
I'm good with just
and you got some nice suits and nice shirts and stuff, but it's just like you're not like, oh, look at I got a
designer.
Calvin Klein
I'm not a designer guy.
Yeah. I got the designer suits that are in my own name. I like those. All right, so I guess should we put that as a potential watch for PVH?
Yeah. I mean, I think it's definitely intriguing.
Okay. All right. Well, let's move on to Pure Storage. And this is one that when you first said it, because you came up with this one here, I thought of like Public Storage, kind of like, a storage company, but that's not what it is. They're actually in the industry of computer hardware. Their symbol is PSTG. 3.4% is a short on the float side. Nothing really concerning there. The PE ratio, not a good start, 187.9 versus the industry of computer hardware at 39.6. Wow, price of sales expensive as well, 7 versus 1.3. Price of book value 16.8 versus 6.4, and price of cash flow 29.7 versus 18.3. I got to ask, why did we pick this company? What did we see in it that we thought it might be something?
Well, I'll just kind of give you that answer since you asked. The shares plunged 25% after their third quarter earnings of 58 cents per share on revenue of $964.5 million. Analysts expected 58 cents on revenue of $956 million. So it's like they were kind of in line.
And when did this come out? Was it
this was last week.
Last week.
But I saw a 25% decline on this business. It's like, maybe there's an opportunity there.
And maybe these numbers haven't quite adjusted yet to the lower stock price or something. I mean, they should, but I'll continue on. So I see why we looked at it. And again, this is important for people to learn that, well, just because the stock drops, we said 25%, doesn't always make it a buy. We do see the earnings per share over last year were down 2.6%. The industry was up 7.8%. Sales did climb by 13.2% when the industry was down 10.2%. The 5-year earnings per share growth estimate from the analysts is 20.2 versus 9.4. They do not pay a dividend. Look at the balance sheet. Current ratio looking pretty good, 1.7, but the industry is 4.2. No problem with debt here, 0.2. That's the same as the industry. Now they have a net profit margin of 3.7. That's just slightly above the industry at 3.4. Return on equity is 9.3 versus 39%. So we like that return on equity at least around 15. They didn't hit that margin there. Free cash flow, also not anything great to write home about. $567 million. The industry is at $2.4 billion. So far, there may be a pullback in the stock price, but maybe still not a buy yet.
Yeah, I'll give you the numbers here. I'm pretty blown away with how expensive it still is. But current price here is $71.32 again for Pure Storage. Their ticker symbol PSTG. The 52-week range, I mean, this is pretty crazy. The low, $34.51, and the high, $100.59. I mean, this stock has been all over the place this year. That is a huge, you're talking about 3 times essentially from the low to the high. And even now at 71.32, you're still up, over 100% from the low this year. I mean, that's crazy. Going forward, though, this company, you go out to January 2027, estimated earnings per share here, $2.29. I mean, it gives you a target sell price, almost just laughable, $38.01. The forward PE is still 33 times. I mean, this business is pricey, to say the least.
Yeah, and I think because it's got that name, storage, if you have AI, remember it used to be if you had .com. I think now storage, like data centers, got to be good. We got to pay for it. I do see that the analysts over the last 9 days, they did bring down their estimates from 241 down to about 229, about a 2.5% drop. So, it's like exciting industry, but that industry, I've heard it, we've talked about it, could be unfolding. So even though this had a big drop on the stock, that does not mean that this is a great buy. I mean, I think you said the stock was, 70 or something now?
71.32.
71.32 doesn't mean it can't go down to 50 or 60 and you lose, again, 20, 30%.
Yeah, I think, kind of talking about all the retail stuff priorly with PVH.
Yeah.
People have so much crap that I'd be more interested, I think, in looking at public storage than pure storage.
Yeah, and that is true, and I'm kind of guilty of it. Like, I've had that shirt for 20 years. Well, I might wear it. I better not throw it away. I might just wear that shirt, and that's kind of normal. I think in society, and that's why we got this huge house, and I think everything's filled with stuff. I mean, my closet is huge, and I've got these shirts I've not worn. I got shirts I know I've not worn them in 10 years, but well, you never know. I might wear it next week.
I'm the opposite. I'm praying my wife didn't get me many shirts for Christmas this year because I'm tapped out in terms of how many shirts. I think I have like 6.
I wish I could be that way, but I grew up difficult times, I guess, and you never threw anything out because you never know.
Well, it makes me feel good because I donate it.
Yeah, but I might be able to use that, and they're gonna buy something else to replace it. But I hear what you're saying. I'm just not.
I'm what they call a minimalist.
Yes, yeah, I try. I actually have a donation pile, and I think I got 3 shirts I put in there. So, all right, well, let's move on to something that you can't keep around, and that's groceries. You do have to consume those, or else they go bad. Although I'm also known for well, who cares about the expiration? It still tastes fine. Who cares? It's December 31st. It's like it's March. It still smells fine. That's my grandmother. It smells fine. You can eat it. Let's talk about Kroger. Yeah. Oh, Priscilla's got to look like, what? You eat that? I'm like, yeah, it tastes fine. My wife is the same way. Let's move on here. Talk about grocery stores. Talk about Kroger. They are in the grocery store industry. I'm sure you know the store. Float on the short side is 5.5%. Not worrisome at that number. We do see a PE ratio that is kind of worrisome. It's pretty high, 55.8 versus 25.6. Price to sales 0.3 versus 0.4. Price to book value 5.8 versus 2.8, and price to cash flow 7 versus 7.1. They do have a PEG ratio 1.8 that is far better than the industry at 13.4. So. Valuation ratio is not really great here. We do see the earnings over the past year for Kroger up 4.2%. Sales are actually down 1.9%. I think they had did they acquire somebody or they got acquired or something? Something was going on with Kroger.
I think they were buying Albertsons.
Yeah, I think I don't know.
I think it didn't go through, though.
It didn't go through. That's what I was thinking as well. They do pay a decent dividend, and this is probably a company that you hold that you're not going to make quick moves on it, but it's could be a good long-term buy if you buy at the right price. But they do pay a 2.2% dividend. Only use 32% of their earnings to pay that out, so that dividend is pretty safe there. Taking a look at the balance sheet, current ratio 1 versus industry at 1 as well. But debt to equity could be a problem here at 2.7 versus 1.9. Again, I will check that balance sheet, see if I see anything there. Net profit margin 1.9, same as the industry. Return on equity is 29.2 versus 16.3. And this is why return on equity is so important, because it's the profit margins on grocery stores is very slim, but you have a lot of turnover. That's why you look at return on equity, because that kind of takes that into account. So very good return on equity, 29.2. Free cash flow, very good, $2.2 billion, about the same as the industry. What do you got going forward, Chase?
Yeah, well, looking at Kroger here, their current price is $63.19. 52-week range, the low here is $58.12, and the high, $74.90. Looking forward for the business, I mean, the valuations, they look, I'm going to say, pretty decent. You go out to January 2027, you see estimated earnings per share of $5.29. Gives you a target sell price of $87.81. Trades under 12 times those future earnings. And the thing that's interesting is earnings growth is pretty strong. I mean, you look at 2026 for the fiscal year, you're looking for about 7.5% earnings growth. 2027, analysts are looking for over 10% earnings growth. So I'm pretty surprised to see that level of growth for the business.
Yeah, and this is a company that you would be looking at investing in, not to, again, have a quick hit on and so forth. This is a company that we would probably like for the right price, that you can hold for years to come, get maybe a 12, 15% on average return each year, year in and year out. That's what we kind of look at. I'm taking a look at the balance sheet here. They do have a fair amount of cash on the balance sheet, about $6 billion. Their assets are about $54 billion. Let me look. I bet you they have a lot of debt. Yeah, they got about $24 billion in debt is what they have, and that is actually up from about 3 years ago, when it was $18.8 billion. So, and I think they did acquire somebody else years ago. And I think you're right. They tried Albertsons, couldn't do it for some reason. So the liabilities are about $44 billion. Their shareholder equity, or their stockholder equity, is about $9.2 billion. That's about the same it was 3 years ago. So it's not an exciting company. And this
What was their debt to equity?
Their debt to equity was, I think, a 1.9. I think is what I saw.
Okay, yes, that's a little bit higher than I'd like to see.
Yeah.
I mean, because the ones that I don't really know of any-
2.7. I'm sorry, 2.7. Even higher than I like.
Yeah, because I was gonna say, I mean, I don't really recognize Kroger. We don't really have Krogers out here in California, and
Isn't there one on Poway Road? I thought there was by the
maybe
theater.
it doesn't really pop up in my mind. But they also have Ralph's, which is more common in my mind here, and then they also have Food for Less as well. But the other thing that they have that I find interesting. They also have Fry's is another one that was more from Arizona. But the other thing I was reading today, it was kind of funny. The article was called "The Appetizer Economy."
The appetizer economy.
And the concept behind the article was more for eating out. All right. But when people are going out to restaurants, they're ordering more appetizers and kind of less entrees. So you go out with 2 people, instead of getting 2 entrees, you get an appetizer and an entree and split it to save money.
Yeah.
But also within that article, they really talked about how the private brands have been growing substantially as well. I forget, gosh, I want to say in like Albertsons or one of the stores, the private brands were going to occupy like a third of shelf space, which was a huge increase to what we've seen. Kroger has their own private brand. So I'd be very curious how the private brands in and of itself help a business like Kroger. You got to imagine that's beneficial to their bottom line.
Yeah, and they probably do get I'll say a better profit margin. But I've often wondered who makes those private brands. Many times it's a company that but they make private brands, which they don't make as much profit off of, but they still do it. I mean, you've got to be a food company to produce that. You can't just,
Yeah, like Kroger can't just use their grocery stores to make food, right? Like they have to have a food distributor. So, I don't know. But the big question is private label more profitable to them than selling like a Kraft Heinz bottle of ketchup? Even though it's cheaper for the consumer, is it more profitable for a Kroger? And could that trend benefit this business?
I think it is, and people can argue with me on this, but I try the private brand sometimes. I just don't think they're as good as the brand names. I mean, I like to eat raw vegetables with ranch dressing. I've tried, I think it's called Select from Albertson. It's like thinner. It's not as tasty as if I get it from... I don't know if ConAgra makes it, but the
Hidden Valley or whatever.
Hidden Valley, yes. Yeah. It's a brand name. It tastes so much better, and I think with the off-brand names or the non-brand names, I just think they pull a little bit out of it to save profits, but it doesn't taste as good.
Yeah, I mean, I'm not sure, but people are buying them. So, but if the economy improves, and again, the whole concept of the K-shaped economy, where the higher end's doing fine, the lower end's not, if things improve for the lower end and they start shifting away from the private brands, well, then that could be again a problem for a Kroger.
And again, and I'm older. You talk about an average family. You've got 3.2 kids. You're working. You're trying to feed these your family. You know what? We got to take the lower brand. We got to save on groceries because it's going to be very expensive. So, that's why.
What do you do with 0.2 of a kid? No, just kidding.
I just pulled it out to make it sound good. That 0.2 of the kid doesn't eat very much. but no, it's just something I look at that what's so great about our economy is that it fits for everybody. And this is when it comes to investing. You have to understand what's going to happen with it. You got to understand the business. You have to understand, you can't ever judge yourself saying, well, this is what I get. But, I made that mistake years ago when I said with Apple.
I don't have a smartphone. Why would I buy Apple? Yeah.
No, it's actually the iPod. When the iPod.
Oh.
I was going to do that. But I like my Walkman, so I missed that boat.
Yeah.
But,
I mean, we did make money off Apple, though.
Oh, we did, yeah. I mean, we made good money off of Apple and some of those other companies. We're very cautious, so we do get out before it gets too crazy, is what we do.
Yeah.
So, but
and I think you're right. I kind of made that mistake actually with a food company. I'm like, because my wife, we eat a lot of like just beef.
Yep.
Kind of like the raw food, so to speak, everything that is like not processed. And, we kind of talked a lot about it. We actually ended up buying a food company in the portfolio this year. And, just my preferences aren't the nation's preferences.
Right.
So you can't make that judgment call for other people, essentially.
Exactly. And you got to look at the nation as a whole. where are people like in the South and the Northeast, and and I still believe back east. I think there's a lot of people back east that still smoke, which is kind of amazing to me.
Yeah, the Altria and Philip Morris, it just blows me away how that stock still continues to do well.
Yeah. That's why you got to do your research. You can't just base it on your own opinion there. So, well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as an investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great educational information there, and you can sign up for the newsletter there as well. Thanks for listening. We'll be back next week right here on the Smart Investing Show.